Well, well, folks, it's the end of the year. Been quite a year. We started 2022, just everything was crazy. All the bidding wars, all the immediate sales, the overbidding on homes, mortgage rates under 3%. And man, what a year it's been. What I want to do today is we're going to see the outlook, what we can see for 2023 coming next year. We've got a few more weeks of this year. We have the second week of January where we'll see an inflection point in things like in pricing and inventory. And we're going to see what we can look. We'll see what the variables we do know and the ones that are going to still be outstanding for the year. But we have some good insight, and let's as we dive in. Before I dive into the agenda, we have the chat. The chat is open, and we have a lot of folks here on the call today. And if you're new to the calls, you'll know that, or you'll use the chat to ask questions. Jeff Graves and Leo Black from the Altos team are in the chat. Sometimes I will make a reference to a link or a resource or something, and you can go to the chat to click and download that, or click through to get that, or follow up with those with questions on the. So that's what our chat box is for, and we're actively using that. So I'm Mike Simonsen. I'm the founder of Altos Research. Every week, Altos Research tracks every home for sale in the country. We look at all the pricing, all of the supply and demand changes, and then we bubble up the analytics to make it available to you before you see it in the traditional channels. Today, we're going to look at what we can see for 2023. We're going to start with the mortgages. There's some, I think, real news there, some real insight. The inventory trends have been top of mind for us, both where they've climbed this fall and where they look like they're going to go over the next year. We're going to look at the data and which of the data is leading for 2023, what we can tell us about home prices and volumes in 2023. And all the way through, what we like to do is help you understand how to communicate this data to your buyers and sellers. Everybody needs to know what's going on right now. Everybody has an opinion, and a lot of people are scared. So the data is the system, is the ability for us to talk about what's happening in the market to maybe correct some false impressions. The data we're sharing here is going to be ahead of the headlines. So many of the headlines are still going to be very bearish, especially around the pricing numbers for several months and sales volumes. And we'll show you why we know that and what we can see coming in the future. And then we're going to spend the last chunk of the call today to look in some of the local markets. It was really interesting during the pandemic. We had a boom across all price points, across all geographies. And what's happening right now is that the correction is not happening evenly across the country. So we're seeing there's some markets that are correcting much more dramatically. Inventory is rising much more quickly, and prices adjusting down much more quickly. And then some markets where that's not happening. And so we're going to look at some of the contrast of those and dive in. And as I mentioned, use the chat to ask questions along the way. Jeff and Lael from the Altos team are in the chat. So that's where we can handle, like, won't be able to answer questions on the fly, but then I'll stick around after the talk and we'll try to answer any questions that come up during the conversation. Before I dive into the data, know that all the data we talk about today is available in the Altos system. And we're mostly talking about the national data in this in the slides today, and then I'll do the local data a little bit later on. But Altos tracks every zip code in the country. And so If you're wondering about your local market, what's happening in your local market, or how to interpret that information for your buyers and sellers, we have a free ebook that you can download, and there's a link in the chat, and that's how to use some market data in your business. So it has scripts, it has ideas, it has strategies for communicating with the data. If you haven't used that ebook, I recommend you go get it because it complements what we talk about with this data very well. All right, let's dive into some data. Let's start with mortgage rates. I've been starting with mortgage rates in the last few webinars because obviously that's the big story for right now. Rates, in this chart, we have multiple years, and each color is a year here. And the brown at the far right side of the chart, that's 2022. We can see rates spiked up dramatically this summer. They eased back down in July and August, and then starting in September, September and October, they spiked up way up again with inflation numbers. What we observed is there's a threshold at about 5.5% on the 30-year mortgage rate, that below that threshold, below 5.5 in July and August, we could see people buying homes, inventory starting to tick down. People were doing transactions. So inventory spiked up dramatically in the second quarter, higher than it has been in several years. And then as rates started this little section of downturn, then people started buying again. Very abruptly in September, the first week of September, rates spiked. And all of a sudden we had this late summer increase in inventory, late summer increase in price reductions, and we could see demand stopped cold. Demand, when rates went from 5.5 to 6.5 to over 7 in that short period of time, demand stopped cold. We've had several weeks of mortgage rates starting to tick back down. They are down again this week with the latest inflation numbers, getting closer to 6%. And that's encouraging. So this threshold is an observation that we have in the data, and we could see very quickly the market slow down after above 6%. So as we come into January, the market resets, the housing market resets in January. We're going to get the clean out of inventory over the holidays. We start getting the first of the fresh new listings in the middle of January, between the second and third week of January, with new pricing and new inventory setting up for the spring selling season. And what we'll be watching for is if mortgage rates at that moment are trending lower and closer to 6 and under 6, that's going to be surprisingly bullish for the market. Now, it's not, there aren't any signals that we're going to have a booming housing market in the next year. But if rates are drifting closer to 6 and under 6, that's going to be significant for buyers. Like there's an affordability threshold of about 5.5. And so buyers have more selection now in most places, and they have better financing than they did last summer. Now you can start to see how the people are going to start to take action purchasing homes. If, on the other hand, rates turn around and start spiking back up, that's going to add real negative pressure very quickly to buyers. They'll stop very quickly, and so that'll be bearish, especially for pricing and transaction volumes in the next year. So keep your eyes on that. As of right now, fingers crossed, rates are easing back down closer to 6%. And here's where we can see the inventory numbers. So total homes for sale in the US, this is single family homes, and we have 8 years of data here. This week, inventory is down 2.5% to 535,000 single family homes. So it's post-Thanksgiving. Inventory always will fall another 1 to 2% this week, next week, and then there's Christmas, New Year's. So we have 3, and then the following week after New Year's, we'll have 4 more weeks of declining inventory. It's very common in many years to have the second to third week of January be the lowest point of inventory. inventory starts climbing back up again. And I expect it to be that case now because there's not enough volume like there has been in the last couple of years, buying volume in January, that inventory kept falling. Now that's not there. So expect inventory to turn the corner. We've really only got about 4 more weeks of declining inventory before it starts climbing for the year. Inventory is still 36% fewer than we had in 2019. So for buyers, we have more selection than we've had in several years, any of the pandemic years, but it's still actually kind of restricted. And it's a funny characteristic that happens because, you know, if I'm buying, like, I still don't have a lot of selection. I have better pricing selection because things have been moving more slowly. I don't have to do the bidding wars. If the price isn't right on that property, I don't have to take action right now. I can wait for the one that is right. There's a lot more opportunity for buyers in this market. And especially if rates tick under 6, I think you're going to see some buyers start to loosen up in that case. So what does that look like? So this is how the year has played out. We can see there's a little bump here at the far right end of the chart. There's a little bump in inventory, and where it started to tick down and then it ticked up. That's that September 1st rate spike. And we can see mortgage rates spiked and inventory climbed till the end of October, which was very unusual. But then at the end of October, rates started ticking back down, and now we're in the 6s, and so now we're on our little seasonal down curve. So we're going to end significantly higher than we started the year, significantly higher than we were at the beginning of 2021, and so, but still fewer than when we started in 2020, just pre-pandemic, and so it'll be about a third, 30% fewer than that. And so here's what it looks like on the new listing side. So one of the reasons that inventory isn't climbing more dramatically is because, so even though demand has slowed way down, the sales, the new listings volume is way down. What we're looking at here is a chart with each bar is a week, and it's the total new listings that come to market. The light portion of the bar are those that went into contract. They go into contract essentially immediately after listing. During the pandemic, we called this immediate sales phenomenon, and it was like as much as a third of the homes that get listed and they go into contract in hours or days, just a couple of days after listing, because there's buyers lined up, there's bidding wars. We're going to list the house on Wednesday and take offers on Saturday. And so that's almost evaporated. There's still the best homes still can go very quickly, but you can see at the far right end of the chart, that's the last week. There's a little rebound in listing after Thanksgiving. So the dip is the Thanksgiving week. We'll have 3 more weeks. Christmas week will be that lowest point of the year, and then new listings will start ticking up in January. So we have 28% fewer new listings each week than we did last year at this time. And so inventory can't build too much because there's simply sellers who are saying, look, it's not a great time to sell. I have a really cheap mortgage, and so I am going to sit on that and not sell my list and sell my house. And you can really see this transition happened right in the middle of this year after the 4th of July week. Listing inventory just went off a cliff, and sellers said, I'm done. Anybody who wanted to sell in 2022, that supply was pulled forward into the first half of the year. They were looking at it, and then they didn't need to sell. So you can actually see this dramatic drop off in the new listing volume. We can see the light portion is getting smaller each week. So that's the immediate sales, right? So buyers know that they don't have to launch into, unless, these immediate sales, there's a few thousand of them, and it's like this really remarkable neighborhood, one-of-a-kind property, and well-marketed, and boom, then they can go very quickly. And so those happen for sure. And But the key here is that new listings volume is 28% fewer than last year this time, and that's going to keep a lid on inventory. This may change as economy slows. If we have a recession, especially if we have a big recession, people are worried about their jobs, or they're losing their jobs. Some of those, that contributes to new inventory. And so there are fewer things like investment properties being bought. That contributes to more inventory piling up. So those are factors that we'll see, but in general, homeowners have locked their mortgages very low. They have lots of equity. And right now, everybody has jobs. So there's really no urgency to sell. So that's keeping a lid on our inventory. And this is our projection. So the last couple of dots on the in the bright red line, that's the last few weeks of the year. We're going to end the year with about 520,000 single family homes on the market, maybe a little less than that. Yeah, maybe closer to 510. But if you've seen this is about what we've been projecting since September. So this September, you can see right in the middle here, the spike of rates is at September 1. And we can see where inventory started climbing at that point. The trajectory had started down, but it actually reversed. So if rates reverse in the first quarter, look for a stronger spike in inventory at that time. And so then here's what we look at for a hypothetical curve for all of 2023. We're going to start the year at the left side here, the dots, 520. We're probably, the last few years, inventory would decline in February and March because there was so much buying happening. But normally it's not uncommon for inventory to climb starting in January. And so you see it starts to climb faster. If rates, especially if rates stay in the mid sixes or higher, you can see how each week we build a little more inventory than we normally do, and we might get close to normal levels by the end of the year, by mid-year. If rates fall back under 6%, you can imagine this curve then tops off much less steep and keeps us in maybe a 600,000 range. So what that means for buyers is it's more inventory, more selection for buyers in 2023. And for sellers, it means still opportunity because inventory is restricted still from where it normally would be. But it also means, as a seller, we can't overprice it, because when rates are at 3% or lower, another $100,000 bid on my bid doesn't translate into much payment difference. But at 6%, like every dollar starts to matter. And so buyers are sensitive to that. So it's it's a pricing strategy for sellers when we're looking at what's happening in the coming year. So we adjust this forecast each week when we get new data. And so we'll keep sharing this as we go through the year. And if we're lucky and we roll into January and February and rates have drifted under 6%, that'll probably adjust this down. We'll peak with fewer properties. We'll have a more normal curve in terms of total inventory levels for the year. So we'll keep our eye on that as we go through the year. So that's the inventory side. That's the supply side. On the demand side, we can track the pendings, the homes pending contract. What we have here is each bar is a week, and the light portion of the bar here, these are the new pendings, new contracts each week. We can see this is almost 2 years of data here. The biggest dip in the middle, that's last Christmas, and then at the far right of the chart, that's right now. So there's only 282,000 single family homes in the contract pending stage right now. That's 35% fewer than last year. It's dropping pretty dramatically, so that even as our new listing volume is restricted, the transaction volume is still very slow. Now it's the holidays, so it's going to happen. It's going to decrease for the next few weeks. And then the second and third week of January is when that'll tick up again. So what we're looking for here is, again, if the rates are below 6, I think you're going to see a nice increase. We'll see the pink part of the line grow as we go into the first and second quarter. That's the new contracts each week. And that's going to be very rate sensitive to the year. It also implies, one of the things that this tells us, is these are the homes that are in contract now. So if they're in contract now, they're pending now, they close in January or maybe February, then those become the headlines in February, March, and April. And so the headlines in February, March, and April are going to be about how sales volume is way down, how prices are down, because that's what's in contract right now. And so the headlines are going to be bearish for several more months. And that's going to be important when we're dealing with our buyers and sellers, because they're going to keep seeing very bearish housing headlines, even if the rate market is better for them. So it's going to be a communication trick for us with buyers and sellers this spring, because the whole spring buying season, the headlines are going to be pretty rough. So something to keep in mind for using the real-time data. Like, here's what's happening right now and what you should know right now, no matter what you heard with the latest announcements, headlines that everybody sees. So that's the pendings. Let's turn to prices. The median price of single family home in the US right now is $415,000. And that's ticked down again this week. And you can see each year curve, home prices tick down the second half of the year. It's very common. In this year, they ticked down more dramatically, more consistently. There were fewer plateaus. Like, home prices are ticking down. We're going to end the year at $400,000. Before that second, third week of January, we'll see a little uptick. And then what's going to be the thing we want to keep our eye out with pricing is in that second and third week of January. And we'll have a webinar about that time. So make sure you tune in for that. In that time, if, for example, rates have spiked up, we'll see that buyers step down. And if home prices don't do a little jump second and third week of January, let's say they tick down again, that's going to be a very strong signal about buyer demand in the first quarter and about how much home prices will decline across the country for the whole year. It's a really fascinating time. In the light colored line here, that's the price of the new listing. So the cohort of homes that got listed for sale in any given week. And I love to include it here because it's a leading indicator of where all the other prices signals will go. So when we go to list a house, the seller and the listing agent are looking around and they take everything they know about the current market. They know, did the house down the street sell? Did it go over or under? Did it have offers? Is there traffic at the open house? I held an open house and nobody came. Now I need to list another house. I'm going to list that at a discount because I know that demand is really light. So that all that wisdom gets baked into the price of the new listings, the light colored line here. And what we can see is we had the Thanksgiving dip at the far right side of the chart. There's a Thanksgiving dip, and then the week after Thanksgiving rebound a little bit. That happens every year. And then we'll get another dip for the Christmas week, Christmas, New Year's, and then are back up. So, and you can see every year, the second and third week, we can see how high it jumps back up. It jumped back up after Thanksgiving. And that says to me, like, the market's doing normal stuff. It's not, for example, We didn't like dip for Thanksgiving and then dip again the week after. So that implies that, it's not Armageddon out there. Like it's not, prices aren't cratering in this moment. They are doing their normal seasonal behavior. And that tells us, that's why I expect that in January, we'll start seeing it. We'll see our normal curve and we'll start seeing it climb up again. So you'll see that both lines start curving up in January. The price, the median price of single family homes in the US is going to end at that moment at about 400,000. And then later in the year, then in the first quarter and second quarter, the red line will be less steep than it was this year. And because it's less steep, we're going to have our year over year comparisons. And that's where it'll show home prices decline in 2023. You'll be able to see the extent of it for the whole year. You'll be able to see it really in January and February and March. We'll be able to tell that already. In January of this year, February this year, we were talking about 10% home price gains for the year. And we could see it in the steepness of that curve already. We can look back to the middle of this chart here in like 2019, after rates had risen in 2018. It was that up curve was much less steep. And so 2019 was only a little bit of price appreciation, like a couple percent year over year. So that's what we'll be able to see of the data in the first quarter. That's why we can look at this data. These are homes that get listed now. They get offers in a couple of months. It closes in a month or two after that. Like we can see really most of 2023 in the first quarter action on these lines here. My basic takeaway on prices. So we'll be negative growth in 2023, less than zero. I don't see dramatic cratering in home prices in the data yet. And especially if rates start drifting below, that'll solidify that. If rates spike back up, we'll be able to watch these numbers very quickly adjust down, and therefore that would adjust our total expectation for 2023 as that happens. Okay. On that light colored line, that price of the new listings, this is, as I mentioned, that's leading for the whole market. These are the first places you see that signal. Wow, I know the house down the street just took a price cut and it's time to list mine. So I'm going to list it at a little discount. So what we do, and we plot that same data year over year, what you can see here is each line here is a year, each color is a year. And the dark red line is this year. And we can see this compression, how we're getting much closer to the pricing of last year. And so in the next few weeks, we're getting much closer to the pricing of last year. And that's another signal that tells us that we will be, like, there's no ability for price appreciation, like above 0%. But also it's not dramatically lower than last year. So it's not saying 20% price, adjustment this year, but it is, see, all the premium of the last year is really starting to work out. And that's why I wanted to include this view. You can see that compression very clearly here. You can also see in 2020, when the pandemic started, that's the tan line. You can see the second half of the year when people were buying, that's when that price appreciation really started to kick in. Like people were buying dramatically more than they normally would late in the year, unseasonal late in the year. So that's what this is showing us, and how you can see it before it gets into the rest of the data. Let's switch to price reductions. So as another leading indicator, the percentage of homes on the market with price cuts. If at a national level, that's about a third of homes, maybe 35% of the homes over the years, 35% of the homes take a price cut before they sell. Sometimes that's intentional, sometimes it's accidental, sometimes it's a crazy seller, but about a third. And when the market's hot, fewer than that have to take a price cut. When the market cools, more than that take a price cut. So the dark red line here is this year. Each line here is a year. The dark red line you can see in the second quarter, price cuts started accelerating. Rates spiked, demand slowed. We have to start cutting our prices. The price reductions had peaked in September. And then September 1, rates spiked, price reductions kicked in again. Demand stopped. Wow, if I'm stuck with my house on the market, I got to cut my price. Then rates peaked at the end of October. Price reductions peaked November 18, and then they're starting to ease back down for the end of the year. Now, after the beginning of the year, we have fresh inventory that comes on. Those don't need price cuts unless they've sat around until, they get listed in January. And if they don't get offers and now it's March, then that's why price reductions start ticking up in the second quarter. But so price reductions will continue to ease down, and we'll reset our curve for the year. So if we end, the year at about 40% and maybe 38%, these are still signs of very weak demand. Right? If a third, 30% think they're overpriced, but 40% have to take a price cut, that's because the organic levels of demand are very weak. This is skewed by a lot of the investor markets, a lot of the Sun Belt, the places like Phoenix and the big boom markets have significantly more price reductions now, like 60%. And I'll show you some of those in just a second. But what it's showing here, we are curving down. Had after that November moment, price reductions kept climbing, that would have been a bigger bearish signal. There's nothing strong here, but at least it's curving back down, and with rates shows some activity happening. We're going to clean up some inventory over the holidays, and then fresh inventory for the spring. Let me switch real quick to show some of the local price reductions data. This is the Altos Advanced Analytics platform. This is where it's a visualization platform on all the Altos data. This is now available to existing Altos customers, and we've turned it on for a bunch of customers. So if you have an Altos premium account, that's at least a county of data that you access, you can have your advanced analytics account available now. If you don't, if you're at a pro level, you can upgrade to get a county, and then you have more data to compare, and then it'll be available to you as well. So let's look at the price reduction. So what I have here is a rank of the top 50 metro markets by price reductions. And they have to have at least a 1,500 inventory. So I'm excluding the tiny little markets, but here's Boise, Phoenix, Austin, all at like 60% of the market having price reductions. They just started. If you look at the spark line, you can see just past the peak. We're finally past the peak and curving down. Austin's curving down a little better. So starting to reset for the year. But remember earlier in the year, in Boise, this time last year, 9% of the market had price reductions. Beginning of the year, 13%, and now 60%. There's a dramatic slowing. This is slowing of inbound immigration from places like California. And in the Florida markets, you can see that it's the big boom markets. And then you can see the Florida markets are all in the same boat, slightly fewer than, say, Austin or Phoenix, but haven't actually turned the corner yet. So the price reductions are still at their peak in Tampa and Jacksonville, where you can see it in Salt Lake. They probably turned the corner and started coming back down. So that implies to me, that the Florida markets have a slightly different seasonal pattern than some of the Western markets. And I'm going to dive into a few of these local markets, and we'll do a little more local data in a second. But what we'll notice is that you can go all the way down here. Here's DC at 41%. We can see now all of a sudden we're looking at Boston at 41%. So Philadelphia 40%. The North and East and Central markets have had significantly less dramatic impact than the West and South. in terms of our correction right now. And I'll show you some of those in just a second. Let me do a couple more slides of data, and then we'll do some local data. Okay, days on market. It's now median market time is over 2 months now. Normally by this time of year, it'd be 2.5 months. You can see that we're higher than last year. Days on market's going to go higher. It'll be interesting to see if we get back to our normal time on market. But we've gotten used to, houses selling in 21 days, and that time has passed us. It is at least passes for the year. I actually think that we'll probably, even in the slowing market, we'll probably be not back here like 2017 with 100 days on market by the end of the year. I think we're probably in a new era where things are still going to go more quickly. But over time, you get some junk that stays on the market for, a year or more, that will skew this number higher. So I think the big thing here is, for sellers right now, especially if you're not priced right, market time is already over 2 months. It's still climbing from here. You want to get ahead of this curve, not behind it. And I think that's really what it tells us. I like to look in the Altos data, every market, whether it's a zip code or a state, or this is the national data, we look at every market in 4 price range segments. The high end of the market may be behaving very differently from the low end. Over the last few months, the low end in the US, under 200, really under 350, has been moving more quickly. That's starting to slow, and they're starting to even out. Last month, the under 250 was still, like a month and a half of market time. Now it's starting to climb back up. The real buy box for most of Americans and investors is right at $350,000. So you'll see that we have most transactions happening in that range. Like, that's really a sweet spot. As of right now, you can see across all the price points is really starting to slow down. Definitely over $1 million is significantly slower. And so in the local markets, we can also look at we'll look at the quartiles of price range segments in each of those local markets. Let me do one more data point, I think, and then we'll switch over to the local. This is rental. The dark line here is median rent of single family homes. It's off the peak from earlier in the year. Rents are coming down. It is still 10% higher than it was last year. So rents are still high. And if you pay attention to, for example, the inflation numbers, the CPI inflation numbers, those include rental data that is 6 or 8 months old, which is the peak of rents right now. So over the next 6 months, the inflation numbers will probably start to adjust, knowing that the rental numbers are starting to come back down. They are still higher than last year at this time. And so that's not going to be a negative pressure on inflation. Like, there's still, rents are up, and they've adjusted down. In a recession, especially when people stop forming households, then we'll see rental prices notch down. And the apartment rents, the light colored line, is ticking down too a little bit, but still higher than all of the pandemic times. So, both of those cases, we could see rents starting to tick down week by week, and it's probably encouraging for our inflation number, but it's a sign of a cooling economy. Okay, as a reminder, I'm going to look at the Altos reports for some of the local markets, some of the metros and state markets. Altos does the data for every zip code in the country. And so you can go get the ebook to understand how to interpret the data, to talk about the data, scripts for the data, that kind of thing for your local market. There'll be a link in the chat, so you can click through to get that if you want that. And you can book a consult with our team to discuss your local markets. So let's go look at the local markets. I want to start with Phoenix today because Phoenix it has some pricing data that's, I think, starting to be important to pay attention to. So this is Metro Phoenix in the Altos report here. We can see that median price is lower than last year at this time. So median price for homes in Phoenix are down year over year. They are still trending down at this time of year. And you can see that the last 3 years, this was actually moments when home prices were climbing at this point of year, and they have not turned the corner yet in Phoenix. Be interesting to see what happens after second, third week of January, but there's still downward pressure on home prices in Phoenix. We are still above where it was 2 years ago and way above where we started the pandemic. But you can really see the pricing pressure in Phoenix right now. If we look at the inventory numbers in Phoenix, Phoenix is one of the few markets where we obviously have more inventory than a year ago, prime pandemic buying, significantly more, and more than we did at the start of the pandemic. So Phoenix is one of the few places where we actually have more inventory now than we did at the start of before the pandemic. Phoenix is still lots fewer than it had at the earlier part of the decade, like 2015 or earlier, still plenty fewer available then. But it is notable that Phoenix is like come back, and these are investors and flippers. These are the iBuyers, all of these folks that are stopping buying and starting to list. So you can really see that price impact. And as a result, here's price reductions. So price reductions in Phoenix have been under 40% for several years and really low. And then this year we're in the 60s. Have rounded the corner for the holidays. So, maybe we get back down here closer to 50 if we're lucky and rates are low and we have some transactions. Maybe it comes under 50 this year. But this is really a signal of where future prices are going to transact in Phoenix. So Phoenix prices are already down in Phoenix year over year, and the price reductions are still elevated. Like there's a lot of signal in there. We can see, in fact, we can look at price reductions in the segments, and we can see that where all the investor activity is in the lower part of the market has actually the most price reductions happening in Phoenix. At the high end of the market, because it's a slower market, there's actually fewer price reductions right now, which is a really interesting thing. That really says, out of state buyers buying, investors buying, like all of that stuff has slowed, and that's why the price reductions are kicking in more in those parts of the market. Okay, let's go to Boise. Boise is the other big pandemic boom market. We can see that, let's start here. This is price reductions in Boise. So Boise has also been under 40% during the last few years. And while you could see last year this last summer Boise market slowed, it kicked in super fast in the first quarter and then stopped abruptly again. So we're in the 60%, 62% range at Boise. And meanwhile, let's look at inventory. And inventory in Boise is also higher than it was pre-pandemic. So a couple thousand homes on the market. Then, we had as many as 3,800. Inventory is falling for the winter. That's a good sign. It will get back down into sort of a much more normal level there. We can see market time in all price segments, but definitely the $1 million range in Boise is slowing. We could see it in all of the price ranges, very much actually slower than national right now. So that's a really interesting note. But let's contrast that to Pennsylvania. So I was looking with a client at Pennsylvania the other day. And so looking at prices in Pennsylvania, so median price in Pennsylvania, off its summer peak, but still higher than last year at this time. And so like That's a very different market than, say, Phoenix. And that's because, you know, the demand in Philadelphia or Pennsylvania and much of the central and eastern markets, that wasn't driven by like the out-of-state investors coming in and stopping. And so because that didn't stop, then we can look at inventory and look how dramatically low inventory is in Pennsylvania compared to where it was pre-pandemic. So there may be 30,000 homes on the market in Pennsylvania pre-pandemic, and there's still only 15,000 right now. So we're barely above where we were last year at this time. So that's a very different market for buyers and sellers in there, especially if your buyers and sellers in Pennsylvania are reading the headlines about Phoenix, right? It's a very different market. It is cooling though, right? So we know, and we can look at price reductions in Pennsylvania, and we know that price reductions are higher than they have been in several years. We had the same, you have the same slowing there, but you don't have sellers panicking like you did in, like you might have for investors who maybe have fix and flip properties that they're sitting on suddenly at that time. So that's a really interesting note for Pennsylvania. I have Texas open, Texas inventory here. So Texas is climbing inventory, obviously, but below where it was, you know, at the start of the pandemic. Still fewer homes on the market now than we had at the start of the pandemic. Normally, Texas would be on the downslope, you know, this part of the year, fewer homes being available. Texas barely down. And what's happening here in Texas is there's a lot of new construction that was delayed during the pandemic that is now getting listed for sale and hitting the active inventory. And so, especially in places like Austin and Houston, like those things were delayed. And so now we can see inventory building. So as a state, Texas inventory hasn't started falling yet for the year. That's a really telling thing. And I think that'll be a big factor for the next year. A lot of new construction inventory in Texas, and that's going to keep our inventory numbers up, and it's going to keep our things like our market time, our pricing changes, so that the new construction, the new build is going to be much more price sensitive than the existing homeowners, because if a homeowner has their equity and they're locked in at 3%, they don't have to sell, where a builder has a bunch of new homes that have completed, they have to sell. We might see more price reduction action in the new construction than the existing, and Texas will be where it plays out. Let's look at Atlanta real quick. Here's inventory in Atlanta. So we can see we have dramatically rising inventory this year in Atlanta, but still a lot fewer than we did pre-pandemic. Right? That's a very different story than Phoenix. And let's look at price reductions in Atlanta. So we have normally 35% in Atlanta, and now we're at 45%. So obviously slower, not as dramatically slower as the real boom markets of the pandemic, like Austin and Phoenix and Boise. And then we can see in the Atlanta area, the 350 range, that's the bullseye for buyers, for investors, and then suddenly, you know, it's a faster time on market than anything up north of 750 there. Let's do North Carolina. Here's our price reductions in North Carolina. So again, North Carolina acting like Atlanta, right? We have more price reductions. That obviously it's not super hot, but it's not skyrocketing. It's not over 50%. That shows like healthy economy. It shows a reasonable amount of buyer demand, reasonable, knowing where we are this time. And you can actually see the lowest stuff in North Carolina is the fastest days on market we've seen at just over a month, where most of the country we've been looking at is a month and a half, 2 months, 3 months, almost 3 months. And then I've got San Diego open. And I was interested in San Diego because we have, in the California markets, California often has less price reductions than, say, Arizona. And that's because we have a chronic shortage of inventory per capita in California due to the tax laws. So in San Diego, let's look at the price reductions here. Normally maybe 30%. This spring was only 9% of the homes needed price reductions. Now we're at 38, 39. It's plateaued. And you can see normally this time of year is when price reductions will start falling. And so we'll get back down here, hopefully closer to 30%, especially as the rates change. And in San Diego, you can see, the $3 million and up, the super expensive stuff takes longer to sell, but anything at $1.25 million and under is moving more quickly, 49 days, 50 days, that level. And so you can really see where the demand is and where it's not in San Diego. You can also see the absorption rate. The stuff that's getting bought is here at this rate, where significantly fewer at the high end of the market. Things significantly fewer moving. Okay, that's the local data. If I didn't get to your local market, because I can't get to all the local markets, go to altosresearch.com and book a time with our team. Book a consult with our team. If you see it, you understand what we're doing here. If you can get started today, we can have the data in your inbox today. If you're at the Altos premium level, that's at least a county of data. You get the advanced analytics visualization platform built in. So that's brand new. And so I look forward to hearing from you. We've got so much more going on. We'll keep our videos going over the week, and then stay tuned for that second and third week of January, when we'll see our fresh inventory come. We'll have our pricing change, and there's going to be some real signals there for the rest of 2023. All right, that's all the time we have for today. Thanks, everybody. I'll stick around in the chat for a little bit, and we'll try to make sure we answer any last questions.